Hi there. We are starting into chapter 7, looking at long-term assets. Let's jump in. There are two broad categories, tangible and intangible. Tangible, all the physical things that you could touch. Intangible, not physical things, but often much, much more valuable. Patented, trademark, copyright, franchise, goodwill type items. Okay, so balance sheet for Disney, for example, in the thousands, cash, receivables, things in advance that they're paid for, and then these long-term assets here, films and TV rights, investments, parks, resorts, other property, projects in process, land, intangible assets, goodwill, other assets. We'll talk about all those things. Look at the a lot, a lot of value, a lot of investment in these long-term assets, and there's that accumulated depreciation that we'll also get into more in this chapter. So asset acquisitions, identifying major types of PPE, not personal protective equipment, but property, plant, and equipment. So it's recorded at the original cost plus all the costs, all the expenditures it takes to get the stuff ready to use. What's that look like? So for land, the land itself, and then all the other things that it takes to get it ready. So real estate commissions, back property taxes, clearing, filling, leveling the land, cash received from selling stuff, which actually reduces the cost of the land, as you might imagine. So here's an example, purchase price of the land, commissions, cost, but we sold off some existing building or the materials that reduces the cost of the land, right? For total capitalized cost of land, 590,000, and that's a specific term we'll talk about here for expenses that are used just in the current period, or costs that are used in the current period are expenses, but costs that will benefit future periods, multiple future periods, are capitalized, not in a grammatical sense, but in the sense of uh, creating a long-term asset that in most cases is going to depreciate or amortize over time. Okay. Common mistake, not recording that's the cash of the sale from the salvaged items, which reduces the cost of the land. So some improvements that are spent, parking lot, sidewalks, all those things, those are recorded separately from the land account, right? Improvements would be separate. Buildings, all the different types of buildings you can imagine, cost of getting the building ready, realtor commission, remodeling, maybe some renovations if there's asbestos in there, remediating that, any mold or anything like that, and capitalizing all that. Yeah, and when a firm constructs a building rather than purchasing it, capitalizing interest costs, a lot of little nuances here. Equipment, any kind of machinery that's going to be used beyond just the one period, most likely to be property, plant, and equipment. Recurring costs like annual property insurance and annual property taxes, those are expensed. It may seem kind of arbitrary, but the item itself and all the directly related things are long-term, but recurring expenses are expenses on the income statement expenses. Okay, so here's an example, computation of the capitalized cost of equipment. So the purchase price, sales tax, transportation, shipping insurance, all those are capitalized costs. Annual insurance, $1,600 is an expense. Basket purchases, so we buy a whole bunch of things in one batch, so land with building and equipment, allocated across kind of as a ratio according to the relative fair value of the individual assets. So Olive Garden buys this land building equipment for $900,000, estimates that the fair market value of land is 200 building, 700 equipment million, bought the, or 100,000, sorry, total for a million, right? But we got them for 900,000. So how do we do that? Well, divide the cost of the specific item, divide by the total cost to get a ratio, times that basket price to get the allocated cost for each of those items. Natural resources, oil, natural gas, timber, these things are depleted is the word we use for them. For equipment, we use depreciation. Natural resources, we call it depletion instead. These items are recorded at cost plus other costs necessary to get the natural resource ready for its intended use. Same principle as with buildings or land or equipment. Okay, so identifying major types of intangible assets here. Purchased intangible, so buying movie rights, buying TV rights, buying trademark, versus internally developing them. The purchase intangibles are recorded, similar concept we were just talking about, recorded original cost, plus all other costs necessary to get it ready to use. For those developed internally, we expense the costs in the current period income statement um, used in developing those intangible assets. So let's look at this here. So Apple, Google, Amazon, a lot of these, most of these, or all of them for sure, have intangible assets. They acquire some, they develop some internally, but many, like that's the main thing they do, right? With Google, for sure, Apple, definitely a lot of intellectual property, Amazon, a lot of intellectual property, Microsoft for sure, Samsung, Disney, a lot of intellectual property. And they all incur R&D expenses, research and development. These are current period expenses in the income statement rather than intangible assets. So it's just the ongoing process of researching new stuff, trying out, like for Coca-Cola, trying out new flavors, for Disney, trying out new technologies, computer animation, something. For Amazon, new delivery technology, AI technology, whatever they're using. Those are expensed in the current period because it's tough to tell what actually what R&D expenses are allocated to a specific outcome, since it's a lot of it is just general research. Advertising, same thing. We expense that immediately, even though, and we know that advertising will generate value beyond the current period. It's just how it's treated, since it's so very difficult to allocate a specific advertising cost or an ad campaign to specific outcomes. So it's just expensed. And you may not agree with that, and that's fine, but GAAP, generally accepted accounting principles, they just had to decide on here's how we're generally going to account for these things. Key point, we're recording purchase intangibles as long-term assets, but for internally developed intangibles, they're expensed as they go. All right, patents, and we're going to run through a few different types of intellectual properties here. Patents, when purchased, capitalize the purchase price plus legal and filing fees developed internally. Capitalize the legal and filing fees only. R&D are separate. Patent, it's an exclusive right to use something for 20 years. Can potentially be renewed if significant improvements are made to that patent. But like for pharmaceutical drugs, when it comes off patent, that's when that original formulation goes generic. It's that 20-year period that Big Pharma gets to recoup all of its expenses. They could spend millions and millions and multiple millions researching and developing new drugs that fail, right? They never come to market. So it's an incentive to incentivize entrepreneurial behaviors, biotech innovations to try and develop breakthrough drugs. And then they have that 20-year period. And that starts from the day they file the patent, not when the first bottle of pills is sold or whatever, but when they first file it. And it may take another 7 to 13 years for that actually to come to market, to go through all the FDA trials and all the trials to actually get to market, right? So when it comes through, they may only have uh, even as short as 3 years to 7 to 10 years period to recoup those costs. So that's an important consideration for the model, the business model for pharmaceutical companies. All right, so here's an example of this. Company has 2 patents. One was purchased for 200,000. Patent 2 is developed for 200,000. So externally purchases first one, cash expenditures 200,000, legal fees of 40,000. Filing fees, 5,000. So the patent on the books, it was externally purchased 245,000. For the one internally developed, same costs, right? But it will be on the books as only $45,000 asset on that cost. Yeah, the asset would be 45,000 on the books, and $200,000 would be R&D expenses, right? So they're not making income off this in the R&D phase, so they're allowed to expense that to keep their taxable income at a lower level during the R&D phase. Copyrights, exclusive protection to use some kind of creative work, life of the creator plus 70 years. Can sue people for infringing on the copyright. The counting of it virtually identical for patents, trademarks, any kind of word, slogan. The McDonald's M, right, is a good example. The Apple's Apple, renewable for indefinite period as long as it is ongoing business. You're still using that thing to trade for a very specific purpose, can renew it indefinitely. All the legal registration design fees are capitalized, meaning they're created into an asset. Advertising expenses are expensed. In franchises, so somebody pays for an exclusive right to use that franchise's name in a specific geographic area. So like a Subway or a Chick-fil-A or a McDonald's franchise in that specific geographic area. The initial franchise fee is an intangible asset, and then additional periodic payments to the mothership, the franchisor, are typically expensed as they're incurred. All right, and then goodwill, this is kind of the most odd of these concepts. It's not like just good feelings, but it's a portion of the purchase price that exceeds the fair value of identifiable net assets. Okay, only recorded when one company purchases another. It's beyond what just it's worth on paper, right? That additional part is goodwill. Net assets are assets acquired minus the liabilities assumed. Most companies also create goodwill through advertising, etc. But as it does for other internally generated intangibles, the company must expense those costs incurred in the internal generation of goodwill. When it's purchased, then it creates that capitalization. Okay, so here's an example of this. Allied Food buys Ritz for $36 million in cash. Ritz's identifiable assets and liabilities are as follows. Accounts receivable, 10 million. Equipment, patent. Total assets, 50 million. Accounts payable, 9. Long-term, 15. Total fair value of liabilities. So the owner's equity would have been 26, right, to balance that out. So the business acquisition with goodwill, then purchase price is 36 minus the fair value of assets acquired minus the negative fair value of liabilities assumed. So it's 26 million for assets acquired, right? So 36 minus 26 is $10 million we booked on goodwill. Okay, so the transaction will be accounts receivable 10, equipment 32, patent 8, goodwill at 10, and those are the numbers we saw right here, 10, 32, 8, and 10. And then we bought the liabilities as well, or assumed the liabilities, the 9, 15, and 36. Those are the 36 that was paid, but the 9 and 15 were right there for debits equaling credits. So intangible assets don't have no physical substance, generally represent exclusive rights, provide benefits to owners, and those types that we looked at. Okay, and then this last part, describing the accounting treatment of expenditures after acquisition. The question is either capitalizing or expensing it. Expensing it in the current period only. We know it goes beyond, like, theoretically, advertising extends beyond the period, but we're going to book it right then. Capitalizing is going to benefit multiple future periods. Here's a chart, could be handy to print out, make flashcards on. Repairs and maintenance, current, it's expense. All the rest of these are capitalized. If they are major, I bolded all these, they're major repairs, like putting in a new engine in a car, new addition, building a new, like a 30,000 foot addition to a building. Right? That's a major addition. A major component, updating all of the HVAC in a building. I mean, that could be a multi-$100,000 investment. Putting in new elevators, right? Multi-million-dollar investment, probably. These are all capitalized. And then legal defenses, if successful, capitalized, if unsuccessful, womp womp, expensed. And materiality, this would be something you'd have to justify to the IRS, to auditor, something. It just needs to be a big number, right? And that depends on the size of the company. Smaller company, a relatively smaller number could be material. A multi-billion-dollar company, even something less than $100,000 could be immaterial, right? It just depends on what they've done, what's normal in the industry. But at least for as far as homework goes, you'll be told whether it's material or immaterial. All right, and that was it for part A.